A surge in fuel sales, higher prices at the pump. On the surface, Petron's first quarter looked robust, but underneath, the numbers told a different story, one of thinning margins and pressure on shareholders. Revenue soared 27% to 246 billion pesos. Sales volume jumped as global oil prices shot up in the wake of the Israel-US-Iran conflict. Demand stayed strong, both at retail outlets and in LPG, yet gross profit tumbled 22%. Operating income slid even further, down 36%, and net income halved, slumping 56% from the previous year. What went wrong? It wasn't demand. It was the price of keeping up with it. Cost of goods sold rose even faster than revenue, narrowing gross margin to 4.3% from 6.9% a year ago. Petron paid more for every barrel it sold, as global tensions and refinery constraints collided. Outages from scheduled maintenance and storm damage in Malaysia cut into output. When the Strait of Hormuz, a lifeline for global oil, closed, crude prices shot up, peaking at $129 a barrel. Petron found itself squeezed between a volatile market and escalating costs. On paper, Petron grew. Its assets ballooned, driven by a doubling of inventories. But these barrels didn't come cheap. Payables and liabilities for crude soared, overshadowing any growth in equity. Cash reserves appeared higher, yet liquidity weakened as short-term obligations surged. Ratios measuring financial cushion dipped, leaving less room for error if the market turned. Debt didn't explode, but leverage worsened. Swelling payables and foreign exchange losses cut deeper. The peso's decline piled on more pain, with over 2.5 billion pesos lost to currency swings in just 3 months. In the end, common shareholders saw almost nothing from Petron's expansion. Net income to common stockholders was negative, earnings per share slipping below zero, from positive territory a year ago. Petron insists it is shoring up its supply chain, diversifying sources, and keeping costs in check. But the quarter's verdict is clear. In an oil shock, selling more fuel at higher prices guarantees nothing for investors. The path ahead looks demanding, as margins remain fragile and the global energy landscape grows more unpredictable. Investors are left with a hard truth. Bigger sales do not always mean better returns, and sometimes they spell greater risk.